Hello there and welcome back to my YouTube channel, James here as ever for today's video all about ACCA, Financial Management and Working Capital Management. This is lecture 3 in an 8-part series designed to help ACCA students who have got their upcoming Financial Management or the F9 examination. If this is the first time you visited my channel before, and I'm assuming you've clicked on this video because you're an ACCA student and you're doing the Financial Management paper. My name is James, I'm an ACCA qualified member from the UK, and on my channel I help out ACCA students around the world pass their upcoming examinations. And as well to mention, every video is dedicated to an ACCA student out there who watches my videos and watches my content. And today is no different because, as you can see here, I'm getting better at the editing now, as ever. Jasmine as well dropped me a lovely message on Instagram, so all my details of that are at the bottom below. But unfortunately, Jasmine, I'm really sorry to hear that you failed on this, but if you watch all of the actual 8 lectures along with my other videos on the channel, they will definitely help you to pass your upcoming financial management exam from my experience. Trust me on it. You follow the tips, go through the syllabus, practice questions and past papers, you will be fine to get through this. Let's do it together. Well, if this is the first time you've actually visited my channel, as I said, feel free to subscribe so you get access to all of my free content. And whilst you're down there, if you've got any other questions or comments or sort of feedback on the lecture series, feel free to leave me a comment as well. I answer absolutely all of them, and it's lovely to hear what you actually think of the videos. Whilst you're down there, as ever, feel free to give it a massive like and thumbs up so that more ACCA students can see this content. I really appreciate it. And I hope it could be that difference that gets you into the 50 plus so that you pass your upcoming financial management exam. Well, without any further ado, make sure you're getting nice and comfy now, pen and paper at the ready, lots of notes to take because this is such a key topic. Let's take you through it from start to finish, and I really hope it helps. So on 3, 2, 1, and go! Hello and welcome to Lecture 3 on the Financial Management ACCA syllabus, where in today's lecture we're going to be talking about working capital management. My name is James, and in today's lecture we're going to be going through the 3 key elements you can see on your screen. These include the nature, elements and importance of working capital. Secondly, we've got the management of inventories, accounts receivable, accounts payable and cash, all fundamental aspects of working capital management. And thirdly, determining working capital needs and funding strategies. This is another highly examinable area on the Financial Management F9 paper, so make sure you understand all of these key concepts, both calculations and application to the particular industry or working environment. Because, as you can see on the screen now, 4.1 of the ACCA syllabus for Financial Management on Working Capital Management, you've got to look at the actual nature, elements and importance of working capital. And going on nicely to part A on here, we've got to describe the nature of working capital and identify its elements. Well, first of all, it's all going to come down to the actual business itself that we're referring to. But when we're actually looking at the nature of working capital, this relates to how the cash flow flows both in and out of the business. And when it's coming on to identifying the elements, we've already seen that in the opening slide on there, but it really relates into the accounts receivable, the accounts payable, the inventory and the cash, all fundamental areas that you need to be really aware of going into your financial management exam and being confident to apply it to the actual scenario that you could be tested on in your examination. Coming on to part B now, we've been asked to identify the objectives of working capital management in terms of liquidity and profitability and discuss the conflict between them. So objectives, or identifying the objectives of working capital management from a liquidity perspective, this could be actually increasing the number of days in terms of, well, how long does it take for us to get paid by our actual trade receivables, for example. That could be measured. From a profitability point of view, well, we need to increase the profitability of the actual business, but okay, well, how are we going to do that from our role as a financial manager? Well, as we've covered in previous lectures, it's a case of we need to consider the financing decisions, the investing decisions, and the actual distribution decisions, because that all stems from how we actually take cash as our role as a financial manager and then say, well, from our professional judgment, how are we actually going to allocate that? And this is where the actual conflict comes as to, well, should we maintain and hold some cash? Again, it depends on the working and economic environment that the business or scenario you're given is. So that could be holding on to cash for a longer period of time to increase security. It's all about what type of risk management we're looking at here, versus from a profitability or an expansion point of view, taking that cash that we could hold versus investing it into economic generating assets or new potential ventures, whatever it may be. It could be merger or acquisition. And these are the different actual conflicts between the two areas of liquidity and profitability. And there are a variety of examples in financial management, what I've described there. Others could include potentially taking on a loan, which would increase the amount of interest that we have to pay. Well, if you're going to have to make interest payments, that's going to eat into the cash that you have available within the business. And if you don't have as much available cash, then that could negatively impact on the profitability. So it's just to give you a flavour of the variety of different areas that you could be tested on here, and it's that working business knowledge that you need to be applying in your role as the financial manager, what this exam is all about. As you can see, coming on to part C, discuss the central role of working capital management in financial management. Well, we've just hit the nail on the head there as to say, well, we've considered the financing, the investing, and the actual distribution decisions here, but it's all about managing that cash flow. Just think about the cash flow within a business, from paying the employees, paying the trade payables, versus receiving money from the trade receivables, and also on top of that, how much inventory have we got in stock, because that could be deemed to be cash tied up. But again, it also comes down to what scenario you are placed with in your examination and adapting your answer to that scenario, being really specific. That is the key to success in the financial management examination. Coming on to part 2 now, we've got the actual management of inventories, accounts receivable, accounts payable, and cash. So the fundamental key buzzwords on here that you've got to get noted down, that if you were to see the cash operating cycle or the actual working capital management, these are the things that need to come to the forefront in your mind and to go into the financial management in your armoury, because if you don't know that before the exam, then you're going to be going in with a severe disadvantage, because these are the fundamentals, as you can see from the list on the screen. So first of all, explaining the cash operating cycle. So you've got to be aware of the actual formula to calculate that, and as you can see in here, the role that accounts payable and accounts receivable go into. Well, the cash operating cycle is quite simply on there that we've got the accounts receivable days, so you'd have to work out the actual ratio for that. You've then got adding on top of that the inventory days less the accounts payable, and that is going to give you the cash operating cycle. In other words, how many days have we got the inventory tied up for? How long is it taking for our accounts receivable to pay us? And then finally, how long are we taking to actually pay our accounts payable from the business's perspective? And that is where the cash flow will be coming in and out as a result. Coming on to part B now, we're asked to actually explain and apply. Notice the key word apply there, especially for this area of the syllabus. Relevant accounting ratios, including the current ratio and the quick ratio. So get noted down that you will not be given these within the examination, but you've got your current assets divided by your current liabilities there for the current ratio. And from the quick ratio, it's the current assets up at the top, less all of the inventory, divided by the current liabilities. The reason why we deduct off the inventory there in the actual quick ratio is saying, well, I don't think we should take that into account, because if you've got inventory sat on the shelves or within the warehouse, why haven't you sold them already? Yes, I understand there are some businesses where you need some form of stock, but it's just so that we can make a comparison, because especially in the financial management exam, you're going to have to, 1, calculate, and 2, explain. Those are the key areas that you need to develop and make sure you answer the full requirement. As you can see there for part 2, or II, we've got inventory turnover ratio, average collection period, average payable period. We've touched on those already in regards to the accounts payable and the inventories and the actual accounts receivable on there. For part 3, you've actually, when you see a divide like that, you've actually got the sales revenue divided by the net working capital ratio. So in other words, from how well we're managing that cash flow coming in and out of the business, what's that actually transpiring and what's that's relating to overall sales and revenue for the business. In other words, the higher the figure, the better off we're doing there. On to part C, we're asked to discuss, apply again and evaluate, so calculate, say what's happened. The use of relevant techniques in managing inventory, including the economic order quantity model. So make sure you've actually done some research into that before the actual examination. From a quantity perspective, again, it will depend on the actual industry that we're referring to. Some are going to have large warehouses, or they're going to have large amounts of quantity of inventory that's going to be required. And again, that is going to have an impact on how you manage that inventory. That's what it's referring to here. Versus the just-in-time technique, which involves, well, we're going to order in actual goods and inventory so that when we are running really low and it might hit a particular optimal point, that at that particular time, those needed parts or those needed functions of the actual manufacturing process will arrive in time, or just in time, as you can see on here, and the process will actually carry on as it would be. Now, the reason for the just-in-time process compared to the economic order quantity model is, well, the just-in-time process doesn't require you to hold that actual inventory or those goods or those cost of goods or those purchases, so you're actually reducing your potential warehousing costs at the end of the day. So you could be more competitively priced on a lower cost per unit compared to your competitors. But these are all about managing inventory at the end of the day, and again applying it to the particular business, because some businesses are going to have low amounts of inventory versus others that are going to have large quantities of inventory. Coming on to part D now, and again, discuss, apply, evaluate. Make sure you've got that written down in your notes as key fundamental aspects for this exam, and particularly for this part of the actual ACCA syllabus. Now, we're asked to use relevant techniques in managing accounts receivable, so make sure you've got written down there, these are customers who owe us money. They are an asset to the business and will be found within the statement of financial position as a result of this within the assets. So we've got a few key points on here, but again, you'd have to apply these to the direct scenario depending on what the requirement was in your examination. But let's just run through them as to what they actually mean and how you could apply these. Well, first of all, we're actually being asked for assessing credit worthiness. So in other words, why would we go into business with this actual organisation or individual? So you assess their credit worthiness, so looking at their actual annual reports or their accounts, or if they're willing to provide other information that will actually increase their credit worthiness. But in other words, what it's saying is if we go into a contract with this individual organisation, then if we send them goods or we send them services and they have to pay us back, they're going to be part of our accounts receivable, what is the likelihood that they are going to pay? So this can be relating into poor cash flow management of those individuals, because at the end of the day, you spend all that time, those resources going into actually preparing the goods or services, and if you don't get paid for it, it'll be written off as a bad debt within the actual income statement on there. So just a key thing to be getting jotted down. But again, it all comes down to application. Managing accounts receivable, so this is actually keeping track of the total figure. Also, dates are going to be really important. Which actual company year does it relate to as well, so for which accounting period. And then this is where they usually fall into different brackets, that you may have some accounts receivable that are less than 3 months, less than 6 months old, over a year, over 2 years, and then you can quantify it into different areas. And then you have to keep chasing them up about, well, it nicely links into part 3 of collecting amounts owing. So this is communication, building rapport with your actual customers on here, and so that you will do business with them going into the future even more. We've also actually been asked on here for offering early settlement discounts. So this could be, if you paid us within 30 days, we might give you a 2 or 5% discount. So again, it means that the cash is coming back into the business on a quicker basis. We've also been asked using factoring and invoice discounting, again incentivizing our actual customers, our trade receivables, to get that cash flow to be coming back into the business. And then finally, managing foreign accounts receivable. So this is where you've got potential fluctuations, and where if it appreciates or depreciates in a positive or negative manner impacting on the business, this could have a bigger impact as to say, well, once we convert it back into our currency, are we better or worse off? If there is potential future risk of a currency in the future, you want to be getting that cash as quickly as possible. But again, these are all key factors that you would need to be applying to the scenario, but they could ask to say, well, for 6 marks, name some factors, or name and apply to the scenario factors of managing the actual accounts receivable better for the company. That is a typical financial management style question. Then you've got on the flip side of this, coming on to part E on here, discuss and apply again the use of relevant techniques in managing the accounts payable. So this is us as a business, who do we owe money to? Individual organisation. And again, we've got on here using trade credit effectively. So this is where we may sign a contract or go into an agreement with the party who they may send us some goods or some services, whatever it may be, and they say, well, we need to be paid within 30 days or 60 days for trade credit. So if it goes over that 30-day period or 60-day period, then we may lose out on any benefits we've agreed with that actual party. Next, we've got evaluating the benefits of early settlement. So again, it could fall into that 30 or 60 days, and bulk purchase orders. So again, all about saying, well, do we actually need to allow the cash to leave our business yet, because we are better off to hold it ourselves for a bit longer? Or as the actual agreement will state between the two parties. But if we get an actual benefit from the early settlement, it all comes down to the bottom line is, how much do we actually need that cash? If we can hold off for a couple of weeks or whatever it may be, then we should do so that the cash holds within our business for longer. But we also want to balance that with having a good working relationship with that actual party, because most likely if we've bought from them before, we will most likely buy from them again. And of course, relating back to the foreign accounts payable now, linking into the appreciating and depreciating we talked about before, but from the flip side to say, well, are we actually going to have to pay more as a result? So we are potentially worse off. Or it could be on the other side, that the exchange rate currencies have worked in our favour, so we don't actually have to translate as many pounds into euros or dollars, whatever the actual company who we're trading with is based or located. Looking at part F now, and here we were asked to, or one of the key areas of the financial management syllabus is to explain the various reasons for holding cash. So again, trying to put yourself in the perspective of working as a financial manager and saying, why would I make the decision to hold cash within the business? And again, discuss and apply the use of relevant techniques in managing cash. So we've got a few points down on here we're going to link onto, but make sure to note down in your points on here about holding cash or holding a particular amount of cash, because first we've got preparing cash flow forecasts to determine future cash flows and balances. So are we going down a particular line of operations in the future? Were we recently hit with something bad that has happened that is going to negatively impact future cash flows? Are there potentially any lawsuits that we may need to be making a payment out for? Classic example of that. Or were there any damages to our actual operations, so flooding or fires or whatever it may be on there? Assessing the benefits of centralised treasury management and cash control. So this is actually having a specific area within the actual business itself, or a specific team who actually manage the cash amounts within the business. So the benefits are for actually implementing this is so that there are no conflicts of interest, or the team wouldn't be swayed in any way to look to benefit one over the other, because they are meant to be independent and biased as to say, look, these are the rules for the levels of cash within the business that we need to be upholding, so we can't go against that. And this is where it will add security and assurance from a shareholder's point of view that there is no risk of potential, or there will be always risk associated with it, but it's a barrier to the risk of liquidation or potential bankruptcy and shareholders losing their investment being significantly reduced as a result. Always good thing to actually recommend as a potential action for a business to put into play within the financial management exam as well. Thirdly, we've got cash management models that management, boards of directors could look into play. So we've got the Bournemore model on here, so looking for the actual optimal cash balance on here. So looking to actually benefit from how much inventory have we got versus benefiting from interest rates on here. So make sure you go away, have a bit of research actually on this model so that you can actually apply it in a given scenario. You've also got the Miller-Orr model on here, so looking at a business that has potentially uncertain cash flows, so seasonality comes into this. And in other words, what we're looking at here is that an upper or lower, well, both upper and lower limits will be set in terms of cash flow management. And if it was to actually hit one of those upper or lower limits, then it's a trigger to then be going back to a safe cash management amount. But again, make sure you just have a look at some past paper questions, how these can be applied as well. Finally, we've got investing short term on there. As you know, as always, with investing, there are risks associated with it. It all depends on what type of risk appetite does the business or the individual have? Are they a risk taker, to get noted down, or are they risk adverse? So they actually have a lower risk amount that they're willing to take on board. And as we've talked about in previous lectures, if you have a lower risk tolerancy when it comes down to investing, you're more likely to invest in bonds, versus if you've got a higher risk tolerancy, so you've got a higher risk appetite, then it's more likely going to be stocks and shares on there. So that's just to be considering how to utilize your cash, looking at the optimal cash balance as we've seen on there. Utilizing what we can control within the business is the key thing to be aware of here. So thirdly, we've got to consider determining working capital needs and funding strategies now. So again, fundamental topics for a financial manager they'd be looking to undertake in their role. And as you can see on here for part A, calculate the level of working capital investment in current assets. So this is where you need to be really specific to statement of financial position, current assets, less than a year, and discuss key factors determining this level, including, okay, so what level have we got of current assets? And again, think of the actual industry, think of the sector that you're given with the scenario in the exam, and ask yourself, would they be in need of a large amount of current assets or a small amount? Again, depending on the scenario that you're provided with. So because this is going to link into now, first of all, the length of the working capital cycle, so the number of days in your calculation, and the potential terms of trade that we want to go into negotiating and actually applying with our customers and our trade payables, who we owe money to. An organisation's policy on the level of investment in current assets, so where are we going to utilise our cash to the optimal effectiveness. Part 3 on here, whether you were asked to actually consider the industry in which the organisation operates. So we've talked about that before, the actual scenario. Think about, the key thing to get down here is, are we selling, what types of products are we selling? Are they actually potentially perishing? Do they have a long shelf life? Or are we actually in the services game? Where again, it's going to come down to what type of intensity is the business, and how can we actually make that make decisions to the best optimal decision-making process, so that from a working capital perspective, again, we can reduce that trade-off, utilize our cash more effectively, and look to maximize shareholder wealth. That is very, very key. For part B, we're actually asked to describe and discuss the key factors in determining working capital funding strategies, okay? So including the distinction between permanent and fluctuating current assets on there. So you've got to think to yourself, well, within the actual operations of the actual business, okay, how many current assets must we have regardless of the time of year, if we're in a positive or negative situation? How many current assets must we have that must always be there, versus fluctuating, that maybe we actually have some trade receivables that take a long time to actually pay, and then within a day we get a large payment, so you get large fluctuations in your current assets. So again, it all depends on the actual nature of the business and you need to consider and weigh these up in your role as the financial manager. We're also asked on here the relative costs and the risk of short-term and long-term finance. So again, depending on the actual rate that you're offered, what type of loan or long-term finance we're looking at, and the risk of it. So potentially it may be secured against one of our assets. So you need to be aware of what debentures are, that if you make an actual loan to a bank and they say, okay, well, we will offer you the loaned amount, but in assurance of that, if there was the risk of liquidation and potential bankruptcy, we're going to have a debenture in place that if the business folds or there is the risk of complete bankruptcy, then that asset would be sold in order to cover our loan amount on there. And this is where it comes down to that risk tolerancy we talked about and the appetite to say, well, are we a risk taker looking to borrow quite a lot to be more prosperous going forward, or take on less risk and maybe grow more organically or naturally on there. We've also got the matching principle on here that you definitely need to be aware of, a really key accounting concept as to say, well, when the expenses of a business are actually occurred, that is when we are going to account for it. So make sure you've gone back and had a look at your fundamental understanding, especially from your financial accounting and management accounting modules on that. We also then have to consider the relevant costs and benefits of aggressive, conservative and matching funding policies on here. So again, all how it's being implemented within that particular workplace from an aggressive point of view, a quite conservative point of view, and matching the actual and the policies behind it. So these would be always linking into a more discursive area. But again, looking at the costs and benefits, cost-benefit analysis of it, this is going to be more of a discursive actual answer to say, well, we're going to be given an example of when an expense was actually put into play or actually going to be paid. Maybe it was around the year end. What's the actual size of it in proportion to other aspects of the business we will need to consider as well. Finally, on this slide, we've also been asked to look at the management attitudes to risk, previous funding decisions and the organisation size. So the management's attitude to risk could also link into agency theory that has come up on previous financial management examinations, where the management have their own objectives, maybe hitting their bonuses, increasing their potential shares that they may have the right to exercise, that they may want to get into their contract, versus optimizing and maximizing shareholder wealth, which is the main key consideration of operating the business, because the shareholders are the owners. We've then got to look at previous funding decisions. So did we make the correct ones? Was it a long-term or a short-term decision? And then the organisation size as to say, well, what sort of market sectors and segments are we currently operating in? And then relating into the funding decisions, well, are we looking to maybe go into the US market? Are we looking to a home in our current home market? It's all going to depend on the actual scenario that you're presented with in the examination, and taking these key core concepts we've been going through in today's class and applying them. That is the key thing. Describe, discuss and apply are the key aspects, especially within this module on here. So just to recap from today's lecture, we've gone through the nature and elements and importance of working capital management that you would have to implement as an actual financial manager. We've then considered the key aspects within working capital management of inventories, accounts receivable, accounts payable and cash, the factors that you'll need to be able to talk about and describe and compare and contrast the benefits and costs accordingly given the scenario in your exam. And then third and finally, determining the working capital needs and funding strategies. So again, all scenario based, all specific, and if you're really concise as to the point, hitting the nail on the head, you will get the marks based on the things we've discussed within the class today. Well, I hope you found it helpful and thank you very much for listening. Well, Jazzin, and everyone else watching around the world, I hope those lecture slides, information directly from the ACCA Financial Management syllabus is helping you out, because working capital management is such a key area in the syllabus. Trust me on that, it comes up in lots of past paper questions. If you have found today's lecture slides and information helpful, feel free to give the video a massive thumbs up and like. I really appreciate the support. And if you've got any other questions after watching the recording, feel free to leave it in the description below. I'll be more than happy to answer absolutely all of them. And finally, as ever, if you'd like access to all of my free videos and resources and everything I post on the channel, feel free to subscribe. The button will be at the bottom. The ball is in your court as well. But if you don't subscribe, you'll be missing out. I mean, you've still got a few more lectures to go after this. This is the 3rd out of 8. Because after this, what I've done for you is I've left at the back end of this video 2 more videos here. If you click on either one of them, they're definitely going to help you pass your upcoming financial management exam. But as always on that bombshell, I'll see you next time. Cheers.